Welcome to the Happy Hour Money Podcast. My name is Josh Bennett, your host, without my other host today, Isaiah, who is actually sort of on leave today. So it's just going to be me, and I have a special guest, Grant Dougherty, who has his own tax practice. So naturally, we're going to be talking about everyone's fun topic this time of year, which is taxes. So Grant, welcome. Appreciate you coming on.
Yeah, man. Thank you for having me, Josh. It's a real pleasure. And I understand that taxes may not be the most exciting thing to talk about, but for some weird reason, that's one of my favorite things to talk about. So I'm excited to be on here.
Yeah, same. It's one of my, we're both in the tax industry, so it's
there you go.
kind of our time to nerd out. But anyone that doesn't want to listen to taxes, screw them. I'm just kidding.
Yeah, there you go.
Don't mean that, followers. No. Yeah, no. So I mean, yeah, it can be a boring topic, but it's one that's obviously super impactful for everyone because you got to pay taxes every year, and
right.
No one wants to. So.
It was weird, man, because as I was in school, I went to college. I studied finance and accounting in undergrad. I actually went and got an MBA after I got my undergrad. And a lot of what I learned, it was just, I'm just trying to pass this test. I'm just reading this book. I'm just grabbing the material. I'm just doing whatever I can to pass. It wasn't until after I left college and I actually started to get my own money and I had to pay that money back in taxes. That's when it finally all started to click. And that's when the real interest really started to take place. Not only just taxes, but investing in general, just everything financial. That's when it really clicked.
Yeah. I mean, I sort of had a similar experience where I didn't had grown up on the investing side and didn't really realize the impact of taxes until you started seeing okay, you can do everything right on the planning side, but if you get slapped with this massive tax bill, it cuts half your work in half. And I was like, okay, this is something obviously worth getting good at,
right?
Worth really understanding, which, you go on a long spiel about how, our education system, fail a lot of regards, but that's a whole different thing.
Yeah, man, no, definitely. And it's crazy that they have not implemented some type of financial education into our system, especially in regards to taxes. I read a stat that the average taxpayer will pay around $500,000 in taxes in their life. I don't know how true or untrue that stat is, but it's pretty shocking whenever you just sit back and look at it and you're like, $500,000. Wow, if I could invest that money, that's more money back in my pocket that I could use to give back my time.
Oh yeah, absolutely. I mean, one of the things that we talk about all the time with our clients is, you look at budgeting and some of these things with from more of a financial planning perspective, and everyone's trying to cut expenses let me stop paying my $4 for Starbucks. And it's
yeah,
it's, if that's, impactful, sure, go for it. But I mean, really your biggest expenses in your life are pretty much your mortgage and your taxes. If you figure out a way to knock those down, and for most people, especially high net worth individuals, taxes is the most expensive expense you have, period.
Oh yeah. No, that is facts. That is it also, since we're on the thing of facts or taxes or whatever, do y'all have y'all talk about this little joke that how the first 4 months, all the way up until April 15th, you work and pretty much all that money you earn goes straight to taxes. And so in theory, the first 4 months you spend you're not even working for yourself. You're just working to pay the government. And then everything after that is finally yours.
Yeah, I've heard that before, but yeah, no, I always forget about it. But yeah, it's so true. But yeah, no, so yeah, so give us a little bit more about your background. So I know you obviously went and got your MBA, and that's getting out of that's what sort of got you interested. But what led you down the path of starting your own tax practice? You built this big following on Instagram, taking more of an educational approach around taxes. Talk through what got you into that and what sort of inspired you.
It was really the shutdown of 2020, right? When everyone was shut down, that's when I had a little bit more time on my hands to start my own business. But I started an Instagram page and social media presence along with that. And the key to social media is just being consistently showing up every day, providing good content, and just interacting with the different people who interact with you. And over time, it really grew into a large following, and it propelled my business. So before 2020, or even during 2020, I was working in corporate America at a company called Cisco. I was in their finance and accounting division. And so after that, after 2020, I was able to then start my own business at Propelled. And now I do this full time. I don't work in corporate America anymore. So now I'm a little bit more exposed to the self-employed side of taxes, which was a whole new beast that I had to learn to tackle. But that's essentially how my journey went. Was it started off very small. You know, I was in corporate America, got a little bit of free time and just worked and pursued. And now I do this full time, and I love it.
So went through that. I know you went and got your EA. So you get that just as you were leaving Cisco, or like what sort of with that?
Yeah, I got that at the beginning of 2021. So as I started to grow my business, you know, initially my goal was to get the CPA, but that would require me to go back to school, take more classes. Now I got to sit for 4 exams. Probably got to go through a whole course to even figure out how the exams are going to look. So I kind of skipped over that, and I went with enrolled agent, EA enrolled agent. It is, in the tax industry, I would say that it carries the same level of respect as a CPA. The only difference is that EAs are going to be a little bit more tax specific, whereas CPAs are going to be more broad. So, you know, they can do tax, they can do accounting, they can do auditing, they can do different things like that. So the EA was just a quicker route to get federally licensed. And I learned a lot with it, right? You know, the continuing education that I have to constantly do to keep my license up to date. I love it. And, you know, I feel like I learn something new almost every single day. You know, there's so much in the tax world that you can't possibly just go over it with just one licensing course, right? It takes years and years of practice. And sometimes you run across something new dealing with clients, right? I feel like I run across all sorts of things that they never covered in the textbooks.
Oh yeah, almost on a daily basis.
Yeah.
Yeah, actually, this is sort of a side topic, but you know, I think it's an interesting thing, especially for people. Like a lot of people think they need a CPA, but one of the things that I've noticed, and you sort of hit on this, like 'cause I actually thought about going to get CPA too instead of the EA, but then I went and looked at the education requirements because I mean I've been out of school for over a decade, and so and I guess so for those people that don't know, like you have to basically have 150 credit hours in college, which like you graduate in like 120. So it's like it's basically become this huge barrier of entry to get the CPA. And I don't know about you, but like what are your thoughts on like how that's going to impact the future of kind of the tax industry? Like I think it's going to be pretty damning. But your thoughts.
The future from what I've heard is not very bright for just the accounting industry in general, right? Not only do we have most accountants, CPAs, EAs in general, they're going to be more aged than most industries, right? I'd say average age is going to be, and correct me if I'm wrong, you know, I'm just kind of taking a wing at it. I would say the average age is going to be 45 and over, and so.
Actually, I'd heard even higher than that. I don't even know exact numbers, but I heard somewhere in the 50s.
Yeah, I mean, I've heard all sorts of numbers too, but as that population starts to age, who is replacing them? And with all these different barriers to entry with the CPA and just the entire, especially if you go Big Four, right? The environment, from what I've heard, is not very friendly towards accountants. You just have long hours, and I get it. You know, during tax season, things get very stressful. So whenever you get stressed out, you then lash out at some of your coworkers, and people don't like that, right? So I would say the future is not looking good for the accounting industry. There's going to be more demand than there is supply here in the next few years. It is my guess.
Yeah, I think it's, I mean, as you know, both of us being business owners in the tax side, I mean, I think it's also going to create challenges with hiring talent that sort of want to be in this industry with like the higher requirements and stuff, which I think is why like people like you and I have migrated more to the EA because we're well educated,
right,
ready to go forward. But I mean, it doesn't make sense for us to go pay $150,000 just to go get credits to then go sit for a test. And where we can take the test directly from the IRS and skip the line kind of thing. But I've always thought it was fascinating. But your take on that. But
the EA is definitely depending on your situation, right? I would say it's an easier point of entry going the EA route over the CPA route. That's not to say that the EA exam is an easy exam, because by no means is it easy. But if you want to get into the tax industry, the EA route would probably be it'd be an easier entry. It'd be easier to enter going that route versus the CPA. Because I mean, CPA, like you said, you have to go to school. 120 hours is what you graduate with. You need an additional 30, so you're probably going to go to grad school after that. Then when you get your 150, you're just eligible to sit for the test. That doesn't mean you're going to pass the test. And I've heard horror stories about, CPA has like a 30% pass rate or something like that. So, good luck.
Well, yeah, and that's where, for people listening, like there's kind of like, well, I guess three main tiers of like, I'd say like qualifications of tax preparer. There's like your sort of just pure tax preparer. Then there's like EA and CPAs. Then next would be like CPAs and tax attorneys, or like, EAs, CPAs, all those can still represent you in front of the IRS. And a lot of people think that they need the CPA route, but what I'm finding because of these education requirements is most of the EAs I talk to are actually better prepared for working with clients, just because kind of your point, like what the CPAs will do is they have to go through so much schooling and so much testing. And then to make it worth it, they go jump to Big Four to like get, a big salary, where they may be just a cog in the wheel of like doing one piece of this like ginormous audit. And so they actually have a zero real world tax experience.
Right.
Even if they may have the CPA credentials, but like you may have an EA that's been just in the trenches for that same amount of time and is vastly more qualified to deal with taxes. Like I'm sure we can kind of attest to that just with our own experiences, but this seems to me like, so for anyone listening, between a CPA and the EA, that's a big argument for the EA route,
Yeah, no, definitely. Now, who should you go to if you're looking for a professional? I think you want to just find someone who's familiar with your situation, right? I wouldn't go out just specifically looking for, I need an EA to handle me, or I need a CPA to handle me, because some EAs specialize in rental real estate. Some CPAs specialize in auditing. So whenever you're searching for a professional, you just want to find someone who is well-versed in your specific situation. It doesn't have to be an EA or a CPA. Well, you would probably want to get one of them, but there are other credentials. AFTPS, I think is what it's called. It's a certain type of credential that you're not an EA, you're not a CPA, but you're still licensed to, I can't remember what it's called. I have some friends in California who get that. It's some type of credential. But they work with a lot of small business owners, and I actually refer a lot of people to them, but they're neither an EA or a CPA.
Yeah, I've seen like what's the FMV? It's like the business valuation expert kind of thing.
Yeah, so it's something like that.
Yeah, there's a bunch like that. But anyways, let's dig into some of the meat of the more fun part of this. What are some of the biggest questions that you get, or biggest insights you have in towards like tax planning? Like, say,
man.
We'll start with individuals. So like, what are the biggest questions you get from individuals on ways to save on taxes?
Oh, the most common one is, what can I do to lower my taxes, right? That's going to be like the go-to. And there's a lot of different things that you can do. And depending on your situation, it really all depends. If you're a small business owner, I highly recommend getting your bookkeeping set first, right? You can't build a house without a strong foundation. And bookkeeping for small business owners is going to be your foundation. You don't really want to focus on anything too complex before you get the basics down first. And I see that a lot, right? I see business owners trying to, can I do this S Corp and do this and do that? And they don't even have a bookkeeper, right? They don't even have a balance sheet. So, you got to probably, take your foot off the gas, hit the brake a little bit, slow down, make sure you have your fundamentals set before you try to do anything too advanced. Same thing with, rental real estate. I think with one property, you're probably going to be okay. You can probably keep up with everything. But the moment you start getting into 2, 3, 4, 5, 6, and even more properties, highly recommend getting a bookkeeper and separating out each property. Having separate books for each property. That's very, very important. And I mean, there's all sorts of different questions that I get. It really all depends on their situation. Real estate investors ask a lot about depreciation and what can we write off. I have to tell them a lot about what is an improvement versus a repair. Like that's a very common thing that I talk about with real estate owners. With self-employed business owners, one of the conversations I have with them is retirement accounts, right? Do you have a solo 401k? Do you have a SEP IRA? Are you even interested in putting money aside for retirement? If the answer is no, I then try to point them like, okay, well, that's fine. It's not everyone's cup of tea, but have you ever thought about just having a deduction in your back pocket? That's how I like to look at solo 401ks, because you have until the filing extension to, make contributions to your solo 401k. So it could be October, well, let's just say it could be June or July of 2023, and you can make a contribution to your solo 401k and reduce your 2022 taxes. So like there's a lot of different things that you can do.
Yeah, exactly. Let's the real estate one's one of my favorites because that's one we get all the time too. So let's talk through the difference. Like, how would you pitch, like, hey, I'm doing this to my property or XYZ to my property? How would you go about that conversation with whether it's improvement versus
yeah, so there's a few ways to look at it, right? If it improves the overall quality of the property, then it's going to be an improvement. If it's just a simple, minute repair, then you can go ahead and deduct that immediately in the first year. Now, there is a safe harbor limit, depending on if you have an applicable financial statement. It could be 2,500 or 5,000, if I'm not mistaken. So usually I kind of point them in the direction, and if it falls below this safe harbor limit, you could probably count it as a deduction, right? It's going to be a repair. If it falls above that, I would go ahead and call that an improvement, and you might want to just go ahead and capitalize that.
And just to be clear for those listening, this is for like rental properties. So another question,
correct,
I'm sure you get all the time is like, hey, I did this random repair on my house. Is this a tax deduction?
I got a brand new roof. I repaired my roof and got a brand new one. And I'm like, oh, no. That is an improvement. That is not a repair. Maybe if you had a tiny little leak on your roof and you got that leak fixed, okay, we can talk about that being a repair. But yeah, brand new HVAC unit, brand new roofs, things like that. That's going to be an improvement.
Well, and that's like, but people think for their like primary residence that they can write that off, which you actually cannot.
Yeah,
so, like this, if you have it as a rental property, you can, but potentially. But yeah, personal residence, really the only deductions you get are if it's like a tax efficient improvement, or not tax efficient, energy efficient improvement.
Right. Yeah, no, actually, whenever you start getting into, one of the things I get talked to a lot about is depreciation, right? So you have 27.5 depreciation life for residential properties. You have a 39-year depreciable life for commercial properties. However, if you do a home office expense, right, your home office, you can catch depreciation for the business use of your home office. And even though your home is a residential property, that home office is going to get treated as commercial and depreciated at 39 years. So like that's like an example, like a weird, funky example. Another one would be short-term rentals. Even though it's a house in the middle of a neighborhood, you would think, oh, it's residential, depreciated 27.5. But if it is a short-term rental, it has to be depreciated at 39 years.
Yeah. And that's where one of the pitching points for, I guess, working with the professionals, there's so many weird nuances that you just see every single day. And I was talking to one of my colleagues did 10 years as an IRS auditor, so I'm always like picking his brain on like, okay, give me the the details of for behind enemy lines, kind of like how is it he was always telling me that for how they'd approach audits basically is his boss would come in, drop a stack of tax returns on his desk and be like, pick 3. And so that was like the random audit. I mean, I'm sure it's a little bit more high tech these days, but but essentially that, but then he would go through and sort of look for the sort of low hanging fruit of okay, a small business, like in home office, did they depreciate or did they write off their entire cell phone bill or those things that just really stand out. So that's where those tiny little nuances that most people don't even think about or don't even really show up on TurboTax. Those are the ones that can get you.
Yeah. And that's kind of a bummer that, it's easier to spot the low hanging fruit like that than it is to catch, maybe something big. Well, I mean, you can see big things like depreciation, if someone, offsets their income by $150,000, that does show up on a tax return. But yeah, the little low hanging fruit for some reason always sparks more of a red flag than the bigger issues, in my opinion.
Yeah, that's why I don't know if this has been true for you guys as well, but we've seen and heard about basically the primary focus of audits has always been small business owners, just because to your point, they're the ones that don't have bookkeeping, they don't have proper tax controls and things in place, and so therefore when the IRS goes looking, there's a lot of low hanging fruit to catch them on.
Yeah.
Whereas some of the bigger fish that may actually be super fraudulent. Just have learned how to hide it.
for sure. For me, whenever I deal with any type of IRS correspondence or audits or anything like that, it's always been taxpayers that make less than $100,000. I've not dealt with anything that with anyone that made over $100,000 in regard to IRS correspondence or just audits in general.
Yeah. Yeah. So for individuals, so, obviously there's, one of the things I tell clients all the time too is like, when you look at the tax code, about 4% of it's like for individuals. The rest is for like real estate, like rental property owners and business owners.
Right.
For those, like, say I'm just a pure individual, but I want to lower my taxes. What are like the best routes for me to lower my taxes without, being a trigger for the IRS audits?
Yeah, the easiest way, I always joke around and tell people have kids, right? You can get tax credits for having kids. That's a joke, right?
Easy tax deduction.
Yeah.
No headaches or troubles there at all.
Yeah, but you could always look at retirement accounts is always a great one. 401ks, HSAs, IRAs, different things like that. That's always like a great place to start. But in my experience, whenever I see high income, low tax liability, almost always it's because they're investing in real estate and they're using some form of either like accelerated depreciation or something like that to offset the amount of taxes that they're paying. So by far and large, real estate is usually, whenever I see high income, low tax liability, it's because of real estate.
Yeah, that's same. And these days becoming more and more, even short-term rentals, which I know that's one of the things you talk a lot about, is the difference between being an active real estate investor and passive real estate investor. Which if you want to dive into that, go ahead.
Yeah. So usually whenever you have rental income or rental losses, naturally the IRS just declares it as passive, right? So if you have passive income, passive loss, the way how our tax code is set up is that passive losses can only offset passive income. So if you have like a W-2, that's going to be active. So your passive loss from your rental real estate, considering all things, just natural, that loss is not going to offset your income. Now, you can qualify as a real estate professional and you materially participate. That is how you essentially change it from passive to non-passive. But that really only applies to like long-term rentals, right? There's a little subsection in the IRS code in the code that basically says if your average tenant stays for 7 days or less, then you don't actually have a rental property. You don't have a rental activity. And because of that, you no longer have to qualify for real estate professional status on your short-term rentals. You would only have to materially participate. And so that's kind of the workaround that a lot of high earning individuals have been taking to get their feet wet into real estate and still use those deductions against their income.
Yeah, which I think it's a fascinating one, especially the way we're seeing VRBO and Airbnb kind of take.
Yeah.
And granted, they're going through a little bit of a hiccup right now, but
that's the thing, right? I always tell people, whenever you go to invest in real estate, make sure that it's a good financial decision first. You don't want to go and get a rental property just because you can offset your income, right? You don't make a financial move for the tax benefits. You always want to make sure it's a good financial move. And so whenever you get into short-term rentals, you just have to understand the risks that are involved with that type of market, right? This is vacation homes. The moment that, finances get tight, we go through a tough time as a country, people are going to stop spending on luxury spending. They're going to stop going on vacations. They're going to stop getting those $150,000 vehicles. The luxury spending stops first. And so essentially that's what's going to happen with your short-term rentals. Whereas long-term rentals, even if times are hard, people still need a place to live, so that's going to be one of the first things that they pay. So you do have smaller margins on long-term rentals in, overall, but it's going to be a little bit more stable. But again, investing in real estate, there's just all sorts of risks, right? Take 2020, for example, you had all these people who could not make payments on their living expenses. And it's a tough game to play because as a landlord, you want to make sure that you have enough money to pay for all the expenses. But at the same time, in a situation like COVID, where it's a national emergency, do we just kick all these people out and have them living on the streets because they can't pay their rent, right? That's kind of like the risk that's involved with long-term rentals. So a lot of people were essentially coming out of pocket to make sure that their tenants could stay in their rental properties. And I know a lot of people that actually had to sell their rentals because they just couldn't afford it anymore.
Yeah, same. Yeah, it's kind of a crazy thing, but yeah, we always talk about like, hey, paying taxes. Yeah, you obviously want to pay less, but it's a good thing because it means you made money.
Right.
You don't want to make an investment decision that loses you money just for the tax.
Oh,
Like it's a counterintuitive idea, but yeah,
yeah.
we're like, it's okay that you just want to pay less proportionally to how much money you're making is really the goal, not to
Right.
not pay at all. So I know you do a lot of content around, and I sort of share the same viewpoint on Roth IRAs for individuals. Why is that? Why is a Roth IRA kind of your go-to strategy?
Oh man, so Roth IRAs, first off, you can put the money in, you already pay taxes on it. So when you put the money in, it grows tax free. And then once when you reach retirement age, you can actually withdraw that money tax free. And so I think for everyone, creating a bucket of tax free income is very, very powerful. Cause I mean, we don't really know what the future holds, but there's a lot of speculation that rates are going to increase. So if rates do increase, having a tax-free bucket of income is going to be very powerful to withdraw that money out in the event that you have high tax rates. But let's just say that you're absolutely killing it in the financial game. You just have all this money and you don't even need to use your Roth IRA. Well, you can actually pass that Roth IRA down to your heirs and they can receive the same tax benefits that you would have received. And you can skip probate fees as well, in the event that, you pass and you're passing down your assets. So generationally speaking, it's a great way to build wealth for not only yourself, but also for, future generations.
Yeah, 100% agree. And actually, we did sort of built a spreadsheet to like I've always been a proponent of Roth, and I was like trying to prove myself wrong. Essentially, we looked at like for younger people, but even like people in retirement age, like at basically total tax bill like through life, which do you pay more on, the deduction now with like a traditional 401k where you lower your tax obligations today, or with a Roth where you have a higher tax obligation today but less in the future. Pretty much any way we calculated it, Roth won every single time. And yeah, part of the reason for it that we figured out was basically, and actually, well, before I even say that, like we even tried to give the Roth the benefit of the doubt. So like, let's say like, for listeners, like if you get your tax deduction today, so say you contribute to a 401k, let's say your income is $100,000 and you contribute 20,000 just for round numbers. Well, now your income is 80,000. And if your tax rate, say 30%, you saved, what's the math there? $8,000 in taxes.
Yeah, something like that.
So we even did it to where like you had the money, 20,000 invested in the 401k, but also you invested that $8,000 just in a brokerage account. So you invested in tax savings. So even if you invested the tax savings, the Roth still won.
Wow.
Over time. Yeah, which I mean, I'm sure you will know as well as I do. No one actually ever goes and invests their tax deductions. They go on a spending spree April 15th or whenever, whenever the refund check hits. But yeah, so what we've sort of found is it's because of the the RMD. So for individuals that if you don't know, if you're listening, so a traditional 401k or traditional IRA, you get the tax deduction today, but basically then in the future, the IRS is like, or Uncle Sam's like, hey, we gave you a tax savings long enough, like, we want our money, and they require you to take a certain amount out. Where the goal is basically, to your point about like the generational wealth, like for traditional, they want all that money out before you die. Like they want you to basically your last check to bounce from the 401k. But with that, like you hit 72 and you have zero control over your tax bill going forward, and like the calculations are pretty high because you have to take out all this money in a short time frame.
Right.
But yeah, so the Roth, you can just keep growing. It's kind of insane, but like that's the biggest thing is your tax bill. Like even if you're like technically making less money in retirement, like because of that RMD, most people, it kicks into such a higher tax bracket that they end up spending significantly more just as an actual tax rate, but also pure dollars because of the compounding interest over time. Like,
yeah, man. And you actually brought up a really good point also. So kind of going back to like, oh, no one ever invests their tax savings, to that, how do you feel about people who use the argument of, okay, I don't want to make quarterly estimated tax payments throughout the year because I'm going to invest that money and make more money by the time, I have to make this payment. I almost never see that actually work out for anyone. Now, in theory, it's it's great. I totally get it. But what are your thoughts on holding off on on making tax payments until April 15th?
Yeah. So for anyone from the IRS that's listening here, I never recommend that. But
yeah, there you go. That's
no,
good.
yeah, and no, in reality, I mean, yeah. So basically, obviously the IRS and government, they want their money, when it's owed. And so, which that's why like business owners and individuals are required to withhold, right? And business owners should be paying quarterly taxes along the way. Well, if you don't pay those quarterly taxes, you have that interest payment, which, if I remember correctly, I don't know if they've raised it or not, but it was like 6% basically annualized. So when you look at like 6% annualized, like from my perspective, like, okay, you're only paying 6% really on the first quarters. That would be, by the last quarter's owed, you're paying like 1.5% just because of the time that it's been late.
Right.
Because it's not actually 6%. It's basically what 0.5% per month, basically.
Something like that.
Yeah. So yeah, my advice has always been, okay, well, even if you don't reinvest it, well, right now where we are, inflation on paper is like 8-9%. Your bill to the IRS is 6%. You're still making money by not paying the IRS back quickly.
Oh, okay. That's a good way of looking at it.
Just because of inflation. But yeah, I mean, ideally, if it's a business owner and like that's kind of like the inflation one's my advice for even like individuals that like may have like an AMT bill because they exercise stock options or something. Whereas, still same deal. You're going to owe a little bit of interest, but technically the money's worth less.
Yeah, no, I mean that's a good idea. I've never actually put it in perspective like that. So that's a good way of looking at it.
Yeah, with business owners, take a similar approach from like, okay, if your thresholds, call it 4% on average penalty. Well, can you make in the same amount of time more than a 4% return? Yeah, I mean, I'm sure most business owners can.
Yeah,
if they're not a very good business owner, if they're not. And so, like from that argument, yeah, it makes a lot of sense. But the thing I always hedge is like, okay, well, if you invest this into your business, don't get caught with your pants down April 14th, not being, not able to take that money back out of your business. Like say you buy a piece of equipment or something that you're no longer liquid. Well, the IRS still wants their money.
Yeah.
And that's you make sure you can pay the bill eventually.
And that's usually the experience I run across, right? I run across so many people that they want to hold off. They don't want to make their quarterly estimated tax payments, because they want to go and invest the money. And I'm like, okay, just be aware of the penalties and interest that kind of come along with that. And then come April 15th, I tell them like, oh, hey, you owe $100,000. And they're just like, what? Like, there's no way. And I was like, well, I try to tell you, man, if you'd paid your quarterly estimated tax payments, you'd only be owing $15,000 right now, which is probably a lot more reasonable for you. So yeah, I don't know, nightmare stories, man.
Yeah, and like my thought with it too is like, I have no proof of this, but my theory is like, okay, if you owe $100,000, means you made good income throughout the year,
right?
But if you can't pay your bill the 15th, like you can go on a payment plan. So like not the end of the world from that perspective,
right?
But if you made really good money, didn't pay your quarterlies, then go on a payment plan, but are on your tax return showing really good income. Yeah, to me that's gonna be an IRS red flag for an audit.
Yeah,
I don't have any proof of that, but if I'm the IRS, right, like, you make good money, why didn't you pay us?
Yeah.
So yeah, I think it financially makes a lot of sense. It's just whether you want the headaches of potentially dealing with the IRS later on.
Oh man.
And that's where like it goes back to like, if your bookkeeping's immaculate and all these different things where like all your I's are dotted, T's are crossed, you can defend every move you made.
Right.
And you can just say like, hey, we took a chance investing this money instead. It backfired. We're paying our interest and penalties. Happy to do so, or whatever the case may be. Yeah, let's go for it. But make sure you can defend every move that you make with the IRS, because there's definitely going to be higher audit risk, I think.
Oh yeah, no, definitely. Do you think audits are going to start picking up here in the next few years?
I think it depends on like this 87,000 auditors that are supposed to come. If that does happen, I mean, I think, and my colleague that used to work in the IRS like still has a bunch of like buddies there, and he was saying that the the areas of speculation are kind of exactly what you'd expect of, they're going to be looking for crypto people that haven't paid taxes. They're going to be looking for, small business owners that are like just basically doing fraudulent things, or like
how's the ERC for you? Did you how many ERCs did you file?
I actually didn't file. Oh, I filed one.
Okay, I stayed away from that, man.
Yeah, that's most of that, but like that they're saying that like that's gonna be their main point of focus is basically who kind of took money in fraudulently.
Yeah, man.
But yeah, I'm glad we kind of stayed away from it. Like even in for like relevant situations.
Right. I reviewed a tax return the other day. Do you remember what was the credit? The credit for sick and leave, form 7202, I think it was, for self-employed individuals.
Yeah.
I was reviewing a tax return the other day. They had like $19,000 in credits from the paid sick and leave credit, I think it was called. It was 2020, 2021, so I can't quite remember it. But essentially what it was is if you missed work due to COVID, or you were like sick with COVID, then you can claim a credit for the days that you missed. And this guy it was like 70 days or something like that. It was ridiculous. And so I can only imagine how many other tax returns were filed exactly like that. Like clearly I could just look at it and tell like, oh, this is for sure fraudulent. The guy who I was doing it for had no idea that it was there. In fact, he was wondering, hey, the way how it actually came about, he asked me, he said, hey, can you take a look at my 2021 return and, tell me how they got me such a high refund? I want you to do whatever they did. And when I looked at it, I saw that and I was just like blown away. I'm like, oh man, no. No, this isn't good. This isn't good. So that was just like an idea, like, okay, ERC, the credit, the sick and leave credit. I can't remember what the name was called. Family sick and leave credit or something like that.
Something like that.
Yeah.
The PPC or PPP loans.
Yeah.
Those are all gonna be kind of the points of focus, it sounds like, which I mean, if the IRS funding continues and like the hiring spree, I think we're definitely gonna see a pickup in audits. The individuals, I mean, outside of crypto, I don't think that most individuals are higher risk. I think it's gonna be mostly business owners. That's my take. I don't know if you feel the same sort of vibe. I mean, it'd be interesting to see if with the Republicans trying to just literally get rid of the IRS. I think has zero chance of going through, but
yeah, I think that was more of like a publicity stunt, right? There's a certain, there's a lot of support for that, but I don't think the people who support that idea understand the consequences of doing something like that, right? So you abolish the IRS and you have a flat tax kind of come in. Well, who monitors the flat tax, right? You're gonna have the DRS instead of, I don't know, the FRS flat reserve. I don't even know. Like you're gonna have some other entity come in, government entity, and they're going to be monitoring that. So you do away with the IRS only to replace it with another government entity. So
yeah, and that's where my business partner Travis and I were kind of having a philosophical debate about this, like with the go into like more of like a European flat tax or consumption tax, which on paper is like, I think it's a really interesting idea and like probably much fairer system in actuality, but that's a whole different debate. But
right,
we were talking about like if something like that would ever happen in the U.S. and the kind of conclusion we came to is basically not a chance in hell, just because the way power is controlled and the way like legislation is pushed through, it's all like because they like nothing can ever happen in Congress because they're just butting heads.
Right.
All they do is just edit the tax code to influence the whatever law they were trying to enact. They can enact the tax codes to do it.
Right.
Prime examples would be like the sugar tax or like excise tax on cigarettes or like you name it, like or if like, hey, we want to subsidize farming or oil or like now the big ones obviously like energy efficient vehicles and home improvements, things like that. Like it's all done through the tax code. Like so you remove that, you remove Congress's power, which let's be honest, they're never gonna
yeah. No, I mean that's a good way of thinking about it. Never really thought about it like that either.
Yeah, it was just sort of one of those drunken debates that we had, kind of thing. But it was, so I think the Republicans is purely a publicity stunt. But I mean, I think the 87,000 auditors I'm guessing it's going to get dwindled down some because but who knows?
there's those 87,000, don't get it wrong. I do think that we need more funding in general for the IRS, because lately they've been a lot better as far as answering the calls. But I remember last year you would call the IRS and sit on the phone for 5, 6, 7 hours just waiting for someone to answer it. So, use some of that funding for more of like taxpayer assistance. I think that is really where they could, really, take a step forward.
Cool. Yeah, I agree. I know we're winding down on time here, but one last question I have for you. One of the big things we like talking about on this podcast is, becoming work optional, if you will.
Yeah.
Obviously, you made the leap from corporate America to running your own business. What's been the highest benefit of kind of taking the reins, your life by your reins, if that makes sense?
Yeah, I mean, there's pros and cons to it. The pro is that I have more time, kind of like to myself. So I work out of my home. I don't know if you've heard them, but like I have kids here, and they love to call out to dad whenever I'm in here working. So at any moment's notice, I can literally just stop what I'm doing and go over there and hang out with my kids. But the con is I do think I work more now than I did back when I was in corporate America. I mean, it's not uncommon for me to be working till 1, 2, 3 a.m. and then getting back up at 6, 7 a.m. just to continue doing what I was doing, especially during tax season. Also in corporate America, if you have a situation go down, really the only person who kind of comes in and corrects you, or I guess you could call it scold, would be like your manager essentially. Now I'm face to face with a lot of my clients. So if I get, a client who just is in a bad mood, or they're upset about whatever, I actually have to deal with it, face to face with them. And so the conversations can get tough. I've been trying to get better at weeding out who is going to be a good client versus who is just going to be a pain every single time I deal with them. But that would be like a con, is that I actually have to go through that process of finding the bad apples and keeping the good apples.
Yeah, which definitely a challenge.
Yeah.
But cool. Really appreciate you coming on and dropping some knowledge on us. And yeah, where can people follow you if they want to track your stuff? You have a lot of good content.
Yeah, you can check me out on Instagram at Dougherty Tax Solutions. That's my Instagram. On Twitter, I am Doe Tax Solutions, so DOU Tax Solutions. And so you can follow me on either Instagram or Twitter. Those are going to be my most active accounts.
Perfect. Well, again, appreciate you coming on, and yeah, everyone should go check out his stuff. It's chock full of knowledge. So
thanks, Josh.
Until next time, cheers.
All right, take it easy.